Welcome back to the channel, everyone. Here we have an S&P 500 case study. So a bearish trade that was taken on the 24th of April 2024. And here's going to be a case study as to how you could have got into this trade using ICT, SMC, and price action. So what we have here is the 4-hour time frame of the S&P 500, and I'm going to begin to dissect structure the way that I currently see it, right? So if we dissect the most recent structure, here's how I have it. So we have a structural high up here, which I'm going to label with an orange dot. So the orange dots represent structural highs and lows on the 4-hour time frame. So we have a structural high, a structural low, just like this. Ooh. Structural high, structural low, structural high, and then we had a break of structure over here, right? A body confirmed this break of structure. Then we had a structural high up here. Then we had the market give a structural low down here. Okay. Then from here, we saw price giving a structural high, and then a structural low. A structural high is a pullback, and then from here, we've seen a new dealing range. Price has given us a new dealing range from this swing high up to this swing low. So we currently have a new dealing range to work with, right? Structural dealing range, okay, from this region over here. So we see price operating from this swing high up to this swing low down here. So if we use the Fibonacci tool to project how we can then analyze the dealing range, right? The dealing range simply occurs from this swing high down to this swing low, right? So we've had a breaker structure over here. So we're currently bearish on the markets, right? This is bearish structure. The S&P 500, ES, NASDAQ, they've all given us bearish structure to deal with, right? So we've had a breaker structure to the downside. And the way that I was currently looking at the S&P 500 is that we had an order block, sorry, a POI, an order block or a POI, whatever you want to call it, AOI, area of interest. We had an AOI or a POI right over here. So this was a 4-hour POI. And to quickly go over why this was a POI, simply because we've seen price break structure, leave a fair value gap, and we see how price is in the discount. So these are the three things that validate this particular POI. The reason why this POI is validated is simply because we've seen it break structure. So if we go over a three quick rules, we've seen price break structure, we've seen price leave a fair value gap, and we've seen price leave this POI in the premium, right? Notice how we have an equilibrium over here, and anything above this equilibrium is a 4-hour POI, right? So we, as an analyst, should expect price to get up to this POI at some point. But this particular trade was based off the fact that we are in a H4 premium, right? We are in a 4-hour premium. So this is a 4-hour premium. And from here, sells are valid, and we're going to go down on the 15-minute time frame to see how you could have got involved in this trade, right? So if we now go down to the 15-minute time frame, let's begin to dissect the market in a bit more detail. Right, so the way this trade was framed, if we quickly analyze our 15-minute structure, right, what we had is we had a structural high. We had a structural low down here. So 15-minute structure will be in blue, just to keep things simple. We had a 15-minute structural low down here. This low produced a high. And now from here, what we've seen is we've seen a structural low that's produced down here. So this is a structural low, structural high. Sorry about that. So structural low, structural high. And we've seen a structural low all the way down here. So this is our structural low down here. And now from here, we've had a clean sweep of, we've had a clean break of structure, 15-minute break of structure. So this here represents a 15-minute break of structure, right? So if we label this M15, this is an M15 break of structure, right? So we've seen a bullish break. Now, it's very important to understand that even though we've had a bullish break of structure, we can still get involved in this market. We can still take sells. And this is how we do it. So we understand that the 15-minute printed a new high over here. This is the new structural high. So if we get rid of the 4-hour PD arrays, we can begin to dissect how you could have got involved in this trade, right? We understand that we're above an old high, right? So this region over here is that we're above an old high. Okay, so when we're above an old high, what can we expect, right? Above old high. So when we're above an old high, what we need to anticipate is a correction. So we see price push up, correction, push up, correction, push up, and correction. So essentially the way that we are looking at the market and the way this particular trade was framed was that we are looking for a correction in this region, we're looking for a correction in this region, and we're looking for a correction in this region. So these three regions give us our corrections. So if we now go here in the markets, the live markets, and begin to analyze how this particular trade was taken, the way it essentially was taken was like this, right? What we had over here is we have an accumulation or an Asian range that took place over here, right? So our Asian range ends at 5 o'clock in the morning UK time, or midnight New York Eastern Standard Time, right? Eastern Standard Time. So if we go to Eastern Standard Time, so that's 5 a.m. UK time, this line over here delineates the New York midnight opening price. So what you want to do is you want to get a line and you want to draw it across this way. This candle is the New York midnight opening price. So I'm going to label that quickly so people understand. This is the New York midnight opening price, or OP for short. New York midnight opening price. So the trick with this price is you want to take a line and you want to draw it. You want to understand which candle, the 5 a.m. UK candle, and you want to project it across from left to right. You want to project it across just like this, right? And you want to label it. You want to label it New York midnight opening price, right? Eastern Standard Time. Of course, this is midnight in New York when IPTA resets itself. So from this particular point, you want to ask yourself, once the market is open here, this is the opening price. What we see is we see price dip up, right? We see a dip up or a manipulation. This is the London manipulation or the Judas swing of the market. So notice we have an accumulation prior to the open. And this is our London manipulation, right? This is the London manipulation, right? And what makes this a manipulation is simply because price is moving in the opposite direction to where we want it to go. Remember, we're looking for sells because we've just broken a 15-minute structure over here, right? We've just broken 15-minute structure. So from here, we understand that we're looking for sells. So the first thing we're looking for is a sweep of the Asian high, right? So we're looking for a schematic similar to this, which I'm going to draw. We're looking for price to give an Asian range, and after the Asian range, after the New York midnight opening price, we're looking for price to sweep the high before displacing lower, right? And this is what gives us our our bearish manipulation, right? Price moves bullish to go bearish, price moves up to go down, and this here is the ICT Judas swing, or the manipulation in the power of 3. So this is how you identify it. So a dummy's way to identify it, a dumbed down version, is to draw a line from your New York midnight opening price, and it's to project where exactly you see the London manipulation, right? This is the London manipulation, or simply the ICT manipulation, as part of the power of 3, okay? So now that we've done that, what we see is we want to wait for New York session. So when it comes to the indices, New York session has a very specific time. New York session has a very, very specific time, and that time window, right? If we look at it in terms of Eastern Standard Time, that time window is 9:30 to 11:30 a.m. Eastern Standard Time, right? So wherever you are around the world, you want to calibrate your timing to this you want to calibrate your charts to this particular timing, right? Everything in the ES or the S&P 500 or SPY or NASDAQ or US 30, everything operates from this time zone. This is the 2-hour time window you want to get in. This is where your maximum A+ trade setup will present. This is where the volatility is the highest, okay? So what we're looking for now is looking for a clear shift of market structure in those times, right? So what we see over here is we see 2 breaks of structure to the downside. So we see a break of structure in London. So we saw the London session break structure to the downside, right? Which yet again confirms our overall bearish intent. So we see a break of structure in London, and the New York session gives us a very clear structural break, right? So I'm going to label this BOS, right? Breaker structure, or some people call it MSS, market structure shift. This here is one of our first rules to keying off a particular order block, right? We see a breaker structure. This is rule number 1, ticked, breaker structure. The second rule we want to identify is a fair value gap, and that's this candle over here. So this candle printed at 3:30 or 15:30 UK time, which is the equivalent of 10:30 Eastern time. So you have to ask yourself, is this a time-based fair value gap? Is time matching up with price? And the answer is yes, because again, remember our timing, like I just said previously a few moments ago, our time for looking for those high probability trade setup is from 9:30 to 11:30, right? 9:30 to 11:30 Eastern Standard Time. So we understand that we are 10:30 Eastern Standard Time. So we're bang on in the middle. So our fair value gap has occurred in a specific time window. This is the basic version of a time-based fair value gap occurring during a specific time. So now that we've seen a break of structure to the downside, we've seen a fair value gap over here. So if I quickly label the fair value gap so people understand, we have a fair value gap over here, which I'm going to label in blue. Once we have the structure break in the fair value gap, the last thing we're looking for is we're looking to simply key off a premium area. So what do I mean by premium area, right? If we quickly look at structure from a very simplistic viewpoint, what we had is we had a structural low down here, we had a structural high, and this structural high produced the structural low down here. So what we've had is we've had 2 points we want to consider. We have a swing high up here, or an internal range high, sorry, and we have an internal range low. So this is the high and low of the session dealing range we're currently working with, right? This is important to understand. So we've had a break of structure, we've had a fair value gap, and now from here we establish that we want to simply project the Fibonacci tool from the swing high down to the swing low, just like this. And so the reason for doing this is because we want to understand, we want to key off a fair value gap in the premium. So anything above this 50% level is essentially a premium. So here we have an EQ, which is the 50% level. If I bring that to the left, we have an EQ over here. So this EQ represents the 50% level. Anything above the EQ, we all know intuitively from basic SMC concepts, is that it's a premium. And now from here, we understand that we have a well-presented 15-minute order block. So this trade itself was taken on the 5-minute using 5-minute accumulations and manipulations and distributions. For the sake of this video, I'm not going to be going into that because we often keep lower time frame stuff for the members. But this same trade could be taken on the 15-minute time frame. So your entry model, if you understand price and accumulation manipulation, you can take an entry model off the 15-minute time frame. And that's what I'm going to show you now. So what makes the order block valid, right? What makes the order block valid, or where is the order block? That's the question you want to ask yourself. Where is the order block? So the order block itself is this candle over here. Now, what makes this a valid order block, right? What makes this a valid order block? If I label this in gray, this is our M15 bearish order block. So what makes this a valid order block is simply because it meets our rules, right? We need to understand it meets all of our rules. And what are those rules? Well, this is rule number 1. We've seen price break structure, so that's rule number 1. Rule number 2 is that it leaves a fair value gap, so this is rule number 2. And rule number 3 is that it's priced above the 50% level in the premium. So all 3 rules have been met. So from here, our job pretty simply is to key off this fair value gap. So we understand we can have an entry just at the vicinity of the order block. I personally had my stop loss just above these wicks over here, just to remain safe in case there is, if you are trading on the 15-minute time frame, if there are any inefficiencies on the 1-minute time frame, you want to have your stop loss just above there in case price does come higher before heading lower, which is always a possibility. You should be aware of anything in the markets. And from here, we had a nice 1 to 2 or 1 to 3. I believe it was a 1 to 2.5 or 1 to 2.3 R trade. Simply following the systems of accumulation, manipulation, and then catching the distribution, right, which uses our rules of an order block. Very, very important you understand this, right? Time-based entries using the 15-minute time frame. Very powerful time frame if you know how to utilize it.